Hello, class. Welcome to the lecture over the adjusting entries or the adjustment process in the accounting cycle. So what I'll do is I'll go over the T accounts, and so you can kind of get a visual of how it flows through the company. And then also I'll try to do some journal entries for you guys. And also we'll look at the accounting worksheet to show the pre-adjusted trial balance, the adjustments, and then the post-closing or post-adjusted trial balance. So there's a variety of different adjustments that can be made, but 4 of them are kind of like the core of what's usually adjusted in a business. And these are the 4 that are covered in chapter 3. So you are going to adjust your supplies, your prepaid expenses, your unearned revenue, and your depreciation. So let's go over each one of these. So here are our accounts. We have balances in each of these accounts. Some of them we don't have balances in yet. And here are the different adjustments that you made, the ones up here in red. So it says right here that rent of $1,000 was due on the 20th of the month. Okay, so this is the end of the month. So let's pretend it's February. So say it's February 28th, and $1,000 was due for rent on the 20th. So it has been due. Well, if we look down here, we can see that we have a prepaid expense rent. So it looks like we've already paid the rent. But again, expenses are recognized when they're incurred. So we have to show now that it's no longer prepaid. It's now a real expense because we have incurred the rent. So the simple journal entry, so we're just going to credit prepaid rent, and then we're just going to debit rent expense like that. Okay, and I'll kind of color code these so you guys can perhaps follow along. All right. And then I'll set up like a general journal right here for you guys, so you guys can just kind of get a visual aid on how the journal entries look. All right, so, and then let me just put my lines in here like so. All right, so then on February 28th, again, at the end of the month, we would debit rent, or expense rent, and this is going to be for $1,000. And then we're going to credit prepaid expense rent. Okay, now the prepaid expense account, that that can be like prepaid rent, prepaid insurance, prepaid whatever. It doesn't necessarily say prepaid expense. Sometimes it just says prepaid, which so just be sure to on the lookout for that. And then this down here, I'm just type general journal. Okay, so let's go back to the adjustments here. So now adjustment number 2, it says supplies have been inventoried at $3,000. So if we look at our supplies account, it looks like we started off the month with $8,000 worth of supplies, and now the supplies are down to $3,000. So the ending balance of the supplies account is $3,000. So that means that we have used up $5,000 worth of supplies. So we'll credit the supplies account, and we're going to then debit the expense because that's how much supplies we use this month. So now we have to show the drop in the assets as well as the equity, because whenever supplies are used, it takes away from our net worth, our equity. So we have to debit the expense account. So if we go over here to the journal, we're going to debit expense supplies for $5,000, and then we're going to credit the supplies account for $5,000. All right, now adjustment number 3 says the company completed of 12, a little bit of a typo there, completed $1,200 worth of unearned revenue. Okay, so unearned revenue, this is when we get paid before we actually complete the service or give them the product. And So remember, revenue is recognized when it's earned. Well, since we didn't earn it when we initially got paid, it got booked into an unearned revenue account, which is a liability account because we owe them now a service or product in place of that payment they gave us. So now we've actually, let's say we're mowing the yards. So we've actually mowed the yard for $1,200 worth of yard. And so we're going to now just debit the unearned revenue account for the $1,200 of the revenue that we earned. And then we're going to credit the revenue account. So this is where the revenue goes now that we've earned it. So over here on the general journal, we're just going to do February 28th, we're going to debit unearned revenue for the 1,200 and then credit the revenue account for 1,200. Now, finally, under the our last one, so this one's just a little bit more complicated, and this has to do with depreciation. So assets, so for example, like a car is worth less than what you bought it for after you drive it for a while. And that's because the asset depreciates or devalues. And so we have to record that to financially represent the business in an accurate way. So we can see here that the $30,000 piece of equipment, which is right here, has a salvage value of $6,000 and a 12-year life. So I'm just going to do my calculations over here. So we have $30,000 is the purchase price. $6,000, that is the salvage value. So that means that this piece of equipment is going to depreciate for $24,000, has a 12-year life, and that means it's going to depreciate $2,000 per year, and this is just going to be for 1 month. So we're going to then, so this is depreciation per year. This number of months, so there's 12 months in a year, obviously. So then monthly, so this is depreciation per month, $166.67. So how you record that is you're going to debit depreciation expense to show the drop in the equity since the asset's depreciating, and then you're going to credit the accumulated depreciation account because our assets are dropping in value. So that's, and you decrease assets with a credit, so that's why we credit the accumulated depreciation account. The accumulated depreciation account is a contra asset for that reason, just like the expense account is a contra equity account. The higher the expenses go up, the more the equity drops. It contradicts the equity, so it's a contra equity account. Same thing with assets. The more depreciation there is, it drops the assets. That's why we credit it. So it's a contra asset account. So then let's just go over here to this journal entry. So debit depreciation expense and credit accumulated depreciation. Just like that. Okay, so, and then let me color code these. Now it's time for our adjusted trial balance. So you see here we have our pre-adjusted trial balance, and now all we have to do is plug in our adjustments. So we just plug in each of these entries here. So our supplies account has a credit of $5,000, like this. And supplies expense was credited for $5,000. And then, okay, so that takes care of the supplies. And then now let's do the prepaid rent. So prepaid rent here, it was credited $4,000, and then our rent expense is debited $4,000. And then our accumulated depreciation, it was credited for $166.67. Excuse me. And so And then we're going to debit our depreciation expense, $166.67. So that takes care of 3 adjustments. And so what do we have left? Unearned revenue. So this needs to be debited for the 1,200 and then credited the rent or the revenue, I'm sorry, for 1,200. Okay, so that takes care of our adjustment column on the accounting worksheet. And you can see down here that our debits and our credits balance. So that checks out. That means we haven't, messed anything up. So now we need our post-adjusted trial balance. So all this is the balance of the accounts after the adjustments have taken place. So cash is just gonna be the same, 226,000. Same thing with accounts receivable, but prepaid expense is gonna be different because we had a balance of 12,000, and then we credited $1,000, which reduced that account. So now it's down to $11,000 even. Same thing with supplies. It started off at 8, went down to 5,000. So now the balance is 3,000. And as you can see, that checks out up here. And then our equipment has not changed. However, the accumulated depreciation for the equipment. So in fact, I have a typo right there. That now had a 0 balance, and now it has a balance of $166.67. So the net realizable value of the equipment, again, net realizable value, that's going to be the 30,000 minus the $166.67. Our accounts payable has not did not get adjusted. Same thing with notes payable. Now our unearned revenue, it did get adjusted. So it has a credit balance, and we debited it for 1,200. Which reduced that account. So now, let's try this again. So now has a balance of 5,300. Common stock did not get adjusted. Same thing with retained earnings. Dividends did not get adjusted. However, it looks like our revenue was at 30,000, and then we credited it for an additional 1,200. So now it's at 31,200. And these accounts had 0 balances, but they were adjusted for the following amounts. And then it looks like down here that we're balanced, so everything checks out. And so that's the accounting worksheet. So you had the pre-adjusted trial balance, the adjustments, and then the post-adjusted trial balance. And these are typically the 4 adjustments that are made at the end of every month. Now, each business is different. There might be certain adjustments, but on principle, that's pretty much how it goes, universally speaking, throughout the business world. So thank you very much. I hope that helped. Reach out with questions. Thank you very much.